Ladies and gentlemen, welcome to the Small Business Experience. There is a lot going on in the banking sector right now. And if you are a business or if you have a personal account in one bank that has more than $250,000 in it, you need to be mindful that you are an unsecured creditor and you need to maybe consider making some adjustments to that. This video is all about that, giving you ideas on how to avoid losing anything over your $250,000, as well as giving you an idea of which banks are some of the safer banks out there. Let's get started by showing you how did we get here with the banking sector. Well, for the longest time, the federal funds interest rate has been, last 10 years, been literally zero. And in an environment like this, the bank needs to do something with your deposits to make at least a percentage point or more to allow the bank to make money to pay their employees, to cover their expenses, and possibly make a profit. So what they have been doing for basically the last 50 years is investing in safe treasury bills, government-backed treasury bills and bonds, and mortgage-backed securities. Now, this has worked for 50 years, and this worked because as interest rates have dropped over the years, over the past 50 years, really, and even when they increased slowly enough that the banks could hold on to the treasury bills and the mortgage-backed securities to maturity. And as long as they can hold them to maturity, they're not losing anything, they're gaining interest, and all is great with the bank. Unfortunately, in the past year, the Federal Reserve increased interest rates almost 5 percentage points. This is the first time in history that we've seen such an increase. And now this is breaking things in the economy, and it's starting with the banking sector. So what's happening is that because of this quick increase, first of all, consumers of the bank are no longer depositing their money, and they're actually pulling money out because they can take this money that they have in the bank and get a higher interest rate by going directly to investing in short-term government bonds. And because of this, what is also happening is a lot of these mortgage-backed securities and these T-bonds that are, again, deemed safe by the banks if they hold to maturity are not if they have to sell early in an environment where interest rates are increasing. They have to sell these at a significant discount. And that's what happened to Silicon Valley Bank. And a lot of these other banks, many of them haven't sold because they haven't had to, but if they did, and I'll show you a graph on this, they would lose billions of dollars, and that's the risk that's out there. Now, here's the graph that kind of shows you exactly what I was talking about. All of these treasury bills, these bonds, these mortgage-backed securities, if you add up all of these that are in all of the banks, and if all of these banks had to sell today, they would have a loss of approximately $600 billion. So there's basically this $600 billion of unrealized losses on the cumulative balance sheets of all the banks out there. Now and as you can see, this goes back to 2008. So this is significant. We haven't seen anything like this. And this has everything to do with the Fed increasing interest rates as quickly as it has. And this is what happens. So that's problematic, especially for smaller regional banks. And this is why it's problematic for us. If you look at regional banks in general, banks with less than $250 billion in assets, they account for half of all commercial and industrial lending. Small and medium-sized banks account for 60% of total residential lending. Small and medium-sized banks account for 80% of total commercial real estate lending, 80% of total commercial real estate lending. And small and medium business-sized banks account for 45% of total consumer loans. This is significant. Regional and smaller banks play a big role for small businesses. I mean, it's a fact. Now, I want you to listen to this.
In every community bank, be fully insured now. Are they fully recovered? Every bank, every community bank in Oklahoma, regardless of the size of the deposit, will they get the same treatment that SVB just got or Signature Bank just got?
A bank only gets that treatment if a majority of the FDIC board, a supermajority of the Fed board, and I, in consultation with the president, determine that the failure to protect uninsured depositors would create systemic risk and significant economic and financial consequences.
So what is your plan?
Made that determination.
Right. So what is your plan to keep large depositors from moving their funds out of community banks into the big banks? We have seen the mergers of banks over the past decade. I'm concerned you're about to accelerate that by encouraging anyone who has a large deposit in a community bank to say, we're not going to make you whole, but if you go to one of our preferred banks, we will make you whole at that point.
Look, I mean, that's certainly not something that we're encouraging.
That is happening right now.
That is happening because depositors are concerned about the bank failures that have happened and whether or not other banks could also
fail. It's happening because you're fully insured no matter what the amount is. If you're in a big bank, you're not fully insured if you're in a community bank.
Well, you're not fully insured.
So that was Janet Yellen, the Secretary of the Treasury of the United States, and she was testifying on Capitol Hill last week. You heard it from her. The regional banks are not covered the same way as the big banks. And there's actually a term for some of the biggest banks out there. They're called SIBs, systematically important banks. This is an actual term. And the SIBs, the banks, the U.S. banks that are listed on here are JP Morgan, Citibank, and Bank of America. Now, these are some of the largest banks out there, and these are deemed too big to fail. They're so big that if the government allowed them to fail, this would certainly cause a domino effect in our economy and with other banks. So these banks, the government will do everything in their power to prevent a fail, which means that as a depositor, there's a greater chance that they would cover all of your money beyond FDIC. Now, that's not a guarantee, but there's a much greater chance that depositors would be safe and investors maybe not. So you may want to consider this as one of the strategies. But also take a look at this. Now, this was set up by Michael Burry. And Michael Burry, if you are familiar with the name, he was the individual that was the center of the Big Short back in 2008. And he created this graph to kind of give you an example of where all of the banks are when you consider their unrealized losses versus the number of investors or number of depositors with more than $250,000 in the bank. Now, ideally, you want to be in this quadrant, this lower left-hand quadrant. And I want everybody to notice that the one that's probably the lowest right here is M&T Bank. So keep that in mind. But you definitely want to consider the banks that are on the left side of this line, the median line here on the unrealized loss side of the graph. Also notice, look where Silicon Valley Bank was. I mean, they're in just rarefied air way over here. And this is part of the reason why they failed. So be mindful of where your bank is in this on this graph. And ideally, and you'll see this as part of the strategy, is we want to have banks that are more on this side because they're less risky, and preferably in this quadrant. So it's nice to see that M&T Bank is there. But because there's only a few big banks, all the other banks beyond $250,000 FDIC, you're an unsecured creditor. And that's the way you got to look at it, is that you're at risk. There's no way around it. You're at risk. Now, notice this FDIC coverage over the years. Started in 1934, obviously after the 1920s and the Great Depression. There was a need for something. And as time passed, the FDIC coverage increased. So there is a strategy behind that, and it continues to rise. And 2023, are we now at infinity? Are we now at a point where they're just going to cover all of our deposits? When I saw this, I thought of two things. The first, it's just an example that purchasing power is dropping as the U.S. prints more money. Every dollar that we print, since it's not backed by any commodity like gold, every dollar we print means that every dollar that we have is worth a little bit less. And there's a breakdown in the trust of the U.S. currency. I mean, this is a fiat system. This is, again, a system of currency that's not backed by anything, so it's backed by trust. And if the trust starts breaking down, so does the whole system. And that is why we need to see greater and greater coverage from the FDIC. And again, we are moving towards having it all covered, which is, to me, a sign that trust is breaking down. Now, where is it headed? There's two possible directions that I believe. The first direction, more depositors will move to systematically important banks, the SIBs. That kind of makes sense. I mean, if there's a greater chance that those banks will not fail, then there's a greater chance your deposits will be safe and covered 100%. We'll also see regional banks merge and or acquired by larger banks. There's just going to be fewer banks out there, and we're going to get to a point where there's eventually only a few very large banks, pretty much just SIBs out there. And where does that end up going? That ends up probably going to nationalization of banks, where the banks and the government, it's all one system at that point, and there's really no difference at all. And then finally, U.S. digital money, crypto type money that's controlled by the government, and there's going to be no paper dollars, which means that the government will even have more control over the transactions that you're making on a regular basis, which causes other issues too. So that's one possible direction. The other possible direction is that there's FDIC coverage for all deposits in all banks, no matter the size of the bank. And that would give everybody a fair level playing field, all the banks. So we'll see what direction it goes, but it certainly is interesting. Now, what I want you to do, this is what I'm telling my clients that they should do, is what I call Operation Cash Dash. So what is Operation Cash Dash? First of all, you want to open as many accounts as necessary to fall within the FDIC limits. So if you have $1.5 million, let's say, you want to have 6 accounts that could bring it down to that $250,000 level if needed. Now, step 2, place a nominal amount in each account. So I'm not suggesting that you move $250,000 to every account, but what I am suggesting is you open these up, add a nominal account, even if there's a fee involved. It's insurance, so think of it as insurance at this point. And then cash dash only if necessary. So the idea here is you're going to have all of these open accounts, and you'll have now access electronically to transfer money as quickly as possible. So if there is a situation where there is a bank run, you can get on your computer at your house and just cash dash, just, start dropping money in all the directions that you need to in order to spread it out to be covered under FDIC. So again, let's just say you have 1.5 million. Currently, $250,000 is FDIC covered. The rest is unsecured. So ideally, what you want to do is set up another bank account, preferably an SIB account, or as we saw, M&T Bank. If that's not your account already, maybe you want to open up an M&T Bank account. And then maybe you do a third bank if you need to, because again, it's worth it if you have the now opportunity to bring that balance down to under that $250,000. Another possibility is an investment brokerage firm like a TD Ameritrade or something like that. Now, some of these are not FDIC insured. However, if there's a situation where you're having a bank run on your bank, more than likely, you're not going to have bank runs on every other facility out there. So just getting your money out there may be the first step. And then you can kind of figure out, give yourself a little time to figure out where can I move this to another FDIC covered bank. Your personal account, maybe you're making a draw or a short-term loan to yourself so that you can max that out. Again, this is all short-term. This is you making sure you don't lose any money for your business. So the idea there is that you want to be safe first. And if you find out that your bank survives the run or whatever, then you could just move the money back with a very short-term loan. And then you could also go right direct to the government. You can open up a Treasury Direct account, which allows you to buy and sell Treasury bonds, Treasury notes directly, and you could just forego the bank. That's one of the safest investments out there. And then what do you have? You have now spread your money to $250,000 or less. That ideally is really where you want to be, ladies and gentlemen. Have that set up. Be ready just in case, because you just never know with this market and this economy. It is a dangerous time and you have to be prepared. Thank you again for coming. I hope you enjoyed this. If you did, please like this, please subscribe, and please share this with other small business owners. Everybody needs to know about this and everybody needs a strategy. I hope you guys have a great day. You take care.